So in our last class, we discussed cost of preference share as well as the cost of debt. We said that the cost of preference share is the compensation required by the providers of preference share capital from their investment in a firm, and that the preference shareholders are entitled to fixed dividend in the company. In the event of liquidation, we said that the preference shareholders will be settled before the ordinary shareholders, but after the debt holders must have been settled. We discussed that there are cumulative, non-cumulative, participating, non-participating, redeemable or irredeemable preference share. We spoke about redeemable and irredeemable preference share. We started with irredeemable, and we said that irredeemable preference share is the one in which the company is expected to pay annual fixed dividend, but the principal will not be repaid, and that the cost of irredeemable preference share is computed as the ratio of fixed dividend to ex-div share price. Okay? Then we move to, of course, we have short examples just to demonstrate the concept. Then we move to discussing our cost of redeemable preference share. And we said the cost of redeemable preference share is the kind of preference share whereby the company is expected to pay annual fixed dividend and the principal at the maturity date. And we said that preference share can be redeemed at par, premium, or at a discount. And the cost of preference share, cost of redeemable preference share, is computed simply as internal rate of return, meaning that anytime you want to compute cost of redeemable preference share, just go ahead and calculate internal rate of return. We had an example, all right, to demonstrate how to estimate cost of redeemable preference share. Not only that, we also mentioned that preference share is quoted at a nominal rate, at a nominal value of 1 naira. All right, preference share is quoted at a nominal value of 1 naira. Okay, and if the par value is, if the nominal value is 1 naira, it means that if it's at a premium, it will be more than 1 naira. At a discount, it will be less than 1 naira. Specifically, we said that preference share will only be redeemable if and only if the redemption date or maturity date is given. If you don't have the redemption date or the maturity date, it should be treated as cost of irredeemable preference share. Then we move to discussing cost of debt. We said the cost of debt is the compensation required by the providers of debt capital. Okay, and the debt holders are entitled to annual fixed interest. And then in the event of liquidation, the debt holders will be paid before the preference shareholders and the equity holders. There are redeemable or irredeemable debts. We have callable or non-callable debts. We talk about types of debts. We said debts can be divided, there are two types of debts. One is traded debts, then two, non-traded debts. The first one, which is the traded debt, we said traded debt are fixed income securities that are tradable. That is, they are fixed income security that can be bought or sold in an organized financial market. Examples include bonds, debenture, and then loan notes. We also spoke about non-traded debts. We said the non-traded debts is a type of security that is not tradable, that is, that cannot be bought or sold in an organized financial markets. Examples include bank loan as well as overdrafts. All right. Then we begin to discuss irredeemable preference share and then redeemable preference share. Under the irredeemable preference share, we said the irredeemable preference share is the one in which the company will pay annual fixed interest, but the principal will never be repaid. All right. And that the cost of irredeemable debt is the ratio of fixed interest to ratio of fixed interest to X int price, depending on whether or not there is tax. And I provided you with two different formulas that you can use to estimate cost of irredeemable debt. Okay. Then lastly, where we stopped is cost of redeemable debt. We say redeemable debt is the one whereby the company is expected to pay annual fixed interest and the principal at the maturity date. Just like you have under the redeemable preference share. Redeemable debts or debt can be redeemed at par, premium, or at a discount. If it's at par, it means at 100 naira because debt is always quoted at 100 naira per unit. So at a premium means that it will be more than 100 naira. It could be 5%, for example, above 100 naira. It could be 10% premium over 100 naira. If it's at a discount, it means that it will be less than 100 naira. Okay? Now, we also said that debt will only be redeemable if and only if the maturity date or the redemption date is given in the question. Okay. And then anytime you are asked to calculate cost of redeemable debt, you are supposed to simply calculate internal rate of return. And there are two steps. Step one is to assume two discount rates that will produce two opposing NPV. Then step two, you estimate cost of redeemable debt using internal rate of return formula. And this is where we stopped in our last class. Today, by the grace of God, we are going to solve examples under the cost of redeemable debt. After that, we'll proceed to discussing cost of convertible securities, right? Then thereafter, I can then introduce you to weighted average cost of capital. If you still have opportunity to solve question, then you can have one or two examples. Yes, Usman, talk to me. You raise hand.
Yes, good evening, sir.
Good evening.
Yes, my question on the rationale for using internal rate of return as the basis for computing cost of debt and cost of preference shares. Maybe you can just throw some more light on it, on the rationale for using simply internal rate of return as a basis for determining the cost of debt and cost of preference share. Thank you, sir.
Yeah, we said that when you talk about internal rate of it's what you want to pay to the providers of capital. That's your cost of capital, isn't it? That cost of capital is the same thing as rate of return. So you are simply calculating rate of return to be paid to the providers of those people that have provided you money to finance your operation. All right. So it's either you call it cost of debt or you call it rate of return on the security, or you to maturity. All right. So it's just a rate of return.
Okay, sir. My question is, yes, sir. When we say a rate of return,
yes,
is it a rate of return looking at it from the holder of the bond or from the from the point of the company?
Yeah, it's the company that is paying it. So it's a cost to the company. But the
Okay,
providers
so
of
it's the company
capital,
is the company that is using it as its own internal rate of return?
so it's the company that is using the money. So because the company is the one paying it. So that's why it's a cost to the company. But the providers of capital that will receive it is a rate of return on their investment.
Yes, sir. What I want to understand is my understanding of internal rate of return is that it's like a hurdle rate It's like a hurdle rate. It's
Yes.
like a basis for saying if my return is below this, I won't take it. If my return is above this, I will take it. That's why I'm asking that question, sir.
Yeah.
That's my
So you're,
understanding
yeah,
of internal rate of return.
yes, it depends on the perspective you are looking at it. All right. So
Yes,
of
sir.
course you are right to say that, because when you say internal rate of return, once your internal rate of return is higher than your cost of capital, you say, okay, the investment is financially viable and stuff like that. Yeah, you are correct. But again, like I said, depending on the perspective you are looking at it, right?
All right, sir.
Okay,
Thank you, sir. Yes, sir.
you're welcome.
Yes.
Uh, let me see. So let's have example to demonstrate cost of redeemable debts. Let's solve this illustration number 9, just as an example. Okay. We read, Emery PLC has 10% redeemable debenture in its capital structure. The debenture is currently quoted at 106 Naira X interest, and it will be redeemed at par in 5 years' time. You required calculate the cost of the company's debenture. So you want to calculate cost of debenture. What do you want? What are you expected to do? First thing first, you go into the question to confirm what kind of debenture is this one? Is it redeemable or irredeemable? Remember what I told you last time. The fact that examiner call it redeemable debenture or redeemable debt does not make it redeemable. Debt will only be redeemable if and only if the redemption date is given or the maturity date is given. So I can see in this question, we are given the redemption date to be 5 years' time. So which confirm that this is a redeemable debenture. Another thing I need to look out for in the question is the market price of these debts. So I need to confirm whether debenture interest has been paid or not. When you look at the question, the examiner has told us that the debenture is currently quoted at 106 Naira X interest. So which confirm that interest has been paid. So I don't need to make any adjustments. One more thing I need to consider here. I must check from the question whether there is tax or not. If I'm given tax rates, that means I need to adjust for tax, because the interest I'm going to use for my calculation must be after tax or post-tax interest. So in this question, we are not given tax rates, so there's no point to incorporate tax. So if that is the case, quickly, let's solve the question. Let's solve the question. That's illustration number 9, page 29. Let me stop sharing this. Okay. The name of the company is Emery. First thing first. Solution to illustration 9, page 29. Emery PLC. We are to calculate cost of debenture. So we have identified that this is a redeemable debenture. So calculating cost of redeemable debenture. Okay. And I told you anytime you want to compute cost of redeemable debts, simply go ahead and calculate internal rate of return, because we said that cost of Cost of debt is the compensation required by the providers of capital. So it's a rate of return on their investments. It's a kind of rate of return on their investments. All right. So to calculate internal rate of return, we are going to assume two discount rates that will produce two opposing NPV. So we are starting with 10%. So we use this 10% to compute NPV. Okay. So the first item here will be the year, description of items. Then we are going to have cash flow. After cash flow, we have discount factor at 10%. Then we are going to have the present value. I will then go back to the question, when are we going to redeem the debenture? We are told that it will be redeemed at par in 5 years' time. So in year 0, the company will pay annual fixed interest. Okay? Sorry, in year 0, this will be the current market value of the debenture. Then the company will pay annual fixed interest for year 1 to 5. All right, so you then write fixed interest. At the redemption date, which is year 5, this debenture will be redeemed. So you then write redemption value. So we go into the question, what's the current quoted market price of the debenture? We are told it is 106 naira x interest. So here will be 106 x interest. If had it been debenture interest has not been paid, we cannot use the 106. You have to less interest from the 106. Whatever balance you have thereafter will represent your x int price. But in this question, the 106 is already x int price. Then the next thing we are going to do is to go and identify the coupon rate, the interest rates on this debenture. We are told 10% redeemable debenture. 10% is the interest rate. So I will come here and put 10. Had it been we are given tax rates, we cannot use 10. It has to be after tax or post-tax interest. So, but in this question, we are not given tax rates. Therefore, we use the 10 as it is. Remember what I told you. Always forget the percentage behind the interest rates. We don't need it because when you do 10% of the nominal value of the par value of 100 naira, you are still going to get 10. Just always ignore the 10%, the percentage. Okay. Now, in year 5, we are going to redeem this debenture at par. At par means 100 naira. Okay. Therefore, let me complete the table so that quickly we are done with this. Remember what I've been telling you from day one. This is not the kind of question you are going to meet on the day of your exam. All this kind of question we have been solving so far, they are just for explanation purpose. They are for explanation purpose. We are here to get to the main calculation. Okay. All right. So I need to get annuity factor of year 1 to 5 at 10%. I want to believe every one of us will, we understand how to calculate annuity factor. But just in case, because we have done this under cost of preference share, just in case there's anyone struggling on how to estimate annuity factor, for example, let me just write it down for you. This should be, okay, let it be here. So annuity factor. AF. annuity factor, or you call it cumulative discount factor, can be computed as 1 minus, open a bracket, 1 plus r raised to power minus n divided by r. All right? Therefore, annuity factor, let me go to the next. Annuity factor at 10%. Okay, would then be equal to 1 minus R is the discount rate that you have assumed. N is the maturity date of the debt. So here will be 1.10 raised to power minus 5, all divided by 0.10. Okay, the final answer will then be equal to, this should be equal to 3.791. 3.791. You do just start with the parentheses. Let me show you. Where's my calculator? You start from the parentheses. 1.1 raised to power 5 minus equal whatever you have in your calculator minus 1 equal divided by 0.1 equal. So we are going to get 3.791. So that's the answer. Annuity factor of year 1 to 5 at 10%. So I will then come here 3.791. Then discount factor for year 5 at 10% will give us 0.621. Okay, 0.621. So we then need to get the present value. Present value, 106 multiplied by 1 will give us 106. 10 multiplied by 3.791, approximately 38. All right, 100 multiplied by 0.621, approximately 62. Okay, then what's the difference? 62 plus 38, that will give us 100. 100 minus 106 will give us minus 6. So we assume 10%. We got negative NPV of 6 naira. So we need to assume a lower discount rate that will produce a positive NPV. Therefore, let's assume 5%. All right. The wise student should go ahead and give me annuity factor of year 1 to 5 at 5%. What do you have? Give it to me. Yes. Okay. Let me use my calculator. Yeah. 1.05 raised to power 5 minus equal minus 1 equal divided by 0.05
4.39.
4.329. Here
Yes.
is 4.329. Then discount factor at 5% for year 5 is 0.784. We then multiply to get the present value. Here will be 43. 10 multiplied by 4.329 will give us 43, rounding. Then here, 100 multiplied by 0.784 will give us 78. All right. So 121, 78 plus 43 equal, that's 121 minus 106 equal 15. So we assume 10%, we got a negative NPV of 9. we then reduce to 5%, you get a positive NPV of 15. Now that you have two opposing NPV, we can then proceed to calculate the cost of redeemable debenture, that is internal rate of return. So KD, cost of redeemable debenture, that is internal rate of return, is calculated as lower discount rate plus net present value of the lower over net present value of the lower discount rate plus net present value of the higher discount rate multiplied by higher discount rate minus lower discount rate. So our cost of redeemable debenture, A is lower discount rate, 5% is lower, plus NPV of 5%, 15 over 15, plus NPV of the higher discount rate, 6. Okay, all of this multiplied by higher discount rate of 15 minus lower discount rate of 10. Sorry, did I say 15? 10
It
and
should be
5.
10 minus 5.
Yeah, thank you. 10 minus 5. Okay, so you then bring out your calculator. 15 divided by 21 equal, then multiply by difference between 10 and 5 equal plus 5 equal to 8.57. This is equal to 8.57%, approximately 9%. So the cost of redeemable debenture of Emery PLC is approximately 9%. So this is how to calculate the return to be paid to the providers of debt capital, that is the debenture holder. All right. So let's have one more example. This is not in your study path. Let me just share with you. Let me have it open somewhere before. Let me see. Let me see. Where are you? Where are you? Where are you? I want to solve the one that involve taxation and to demonstrate for you how you are going to treat it. Okay. All right. I don't know if I've shared this with you before. Okay. Yes, I need one of you to read this illustration for us. Ronaldoli.
Let me read.
All right, thank you.
Okay. Where there is tax, Ronaldoli PLC has an 8% redeemable debenture, currently quoted at 103 naira as at today, 28th December 2018. The debenture will be redeemed at par on 1st January 2022. The company has a policy of paying debenture interest every 31st December. What is the company cost of debenture if, one, the company is not liable to pay tax, and if the company tax rate is 40%?
Yeah, thank you very much. Yes, that is the question. That is the question. The examiner is asking you to calculate cost of debenture if the company is not liable to pay tax and then where tax rate is 40%. Now, first thing first, before you dive into solving the question, you need to bring out some variables that you need to do your computation. As you can see, first thing first in this question, you need to check the nature of the debenture. What kind of debenture is this one? Is it redeemable or irredeemable? Like I mentioned earlier, the fact that debt is redeemable does not make it a redeemable debt. What makes it redeemable is if the redemption date is given. So in this question, we are told that the debenture will be redeemed at par on 1st January 2022. Okay? The debt will be redeemed at par on 1st January 2022. So we can confirm that this is a redeemable debenture. That's one. Then secondly, we also need to check from the question, when is the maturity date? Even though you are told it's 1st of January, how many years? Okay? How many years will these investments plan through? Therefore, we are told in the question that, Abigail, don't write on my screen. All right. So we are told that today is 28th December 2018. So if today is 28th December 2018, and you are told that the debenture will be redeemed at par on 1st of January 2022, you need to count it. How many years do we have there between December 2018 and January 2022? How many years? So you remember, before you can recognize a year, you have to count 12 months. So 28th December 2018 is not a year, it's just a day. All right. So 2018 is not part of it. Your counting will start from 2019. So you have 2019, 2020, and 2021. So 2022 is also not part of it because 2022 is just 1st of January. It's not up to a year. All right. It's just a day. Therefore, we have 3 years. Maturity date is in 3 years' time. That's that. And then the next you also need to confirm from the question is that the debenture interest, we want to know whether the debenture interest has been paid. Examiner told us that today is 28th December 2018, and the company has a policy of paying the debenture interest every 31st of December. If today is 28th, so that means we have not gotten to 31st of December. So in that case, the debenture interest has not been paid. So if the debenture interest has not been paid, the quoted market price of the debenture of 103 Naira represents cum inch price. This 103 Naira is cum inch price. And we can't use the cum inch price to calculate our cost of redeemable debt. So it has to be X inch price. So that is basically that. Quickly, I will stop sharing this, then we solve the question together. Maybe after my class. I don't know if I've shared this question with you before. If not, I will share after the class, or maybe I should just, I don't want to, okay, let me just share with you. Okay. And I've closed my WhatsApp. Oh, still on. SFM online. Okay. So in case you want to check something from the question I just shared with you now, so go there and pick it. All right. Let me stop sharing this and move to the working notes. The name of the company is Ronaldoli. PLC. So we're asked to calculating cost of redeemable debenture. We have identified that this is a redeemable debenture. Okay. We have two different requirements. The first requirement is where there is no tax. So requirement 1, where there is no tax. So we are calculating cost of redeemable debenture. That is, we want to calculate internal rate of return. Okay? So we assume 10% for a start. We then use the 10% to compute NPV. Okay? So create a column for year, description of items, cash flow, discount factor at 10%, then present value. I can use two different tables for our calculation. It's allowed. So create an error sign. Year 0. We have identified from the question that the maturity date is in 3 years' time. So in year 0, this is where you have the current market value of the debenture. Year 1 to 3, the company will pay annual fixed interest. Then at the maturity date, the debenture will be redeemed. How are we going to redeem it? Examiner says at par. So now I will go back to the question. How much is the current market price? What's the quoted price of the debenture? We are told it's 103 naira. But because of the fact that debenture interest has not been paid, therefore, we need to convert the cum-int price to X-int price. Interest rate is 8%. So I will go and do my working. My working will be on the 3rd page. Working number 1. I want to calculate X-int price. X interest price. Why are we calculating X interest price? We are given the market value of the market price of the debenture, okay, to be equal to 103 naira. But because today is 28th December 2018, and this company has a policy of paying debenture interest every 31st of December. Therefore, it means that the market price of 103 naira is cum-int price. So, and we don't use cum-int price to calculate cost of capital. It has to be X-int price. So, and that's why to the price, we deduct interest from the cum-int price. Okay. What's this? Get out. So, let me write this. Interest. All right, so interest is 8%. Just put 8. 8% of 100 naira will give us 8. So the difference would then be 95 naira. Yes, this is X interest price. So this is how to calculate X int price. So I will then come here. Here is 95 naira. Then the interest is 8%. Since examiner told us that where there is no tax, I'm going to use the entire 8, no adjustments. Then how do we redeem the debenture? We are told it to redeem at par. At par means 100 naira. Okay. Then we need to calculate annuity factor of year 1 to 3 at 10%. What do you have? 2.487. Okay. Then discount factor for year 3 at 10%. That's 0.751. So to get the present value, 95 multiplied by 1 will give us 95. 8 multiplied by 2.487. Okay, 8 multiplied by 487 equal 19.896.
19.89.
So approximately that will be 20. Then 100 multiplied by 0.751, approximately 75. Therefore, 75 plus 20 will give us 95. 95 minus 95, 0. So in this case, we don't need to be sweating again, no need to calculate internal rate of return because we have found our answer. You will recall when you did skills level under internal rate of return, your lecturer must have told you that when NPV, when you assume a discount rate that produces 0 NPV, that discount rate is your internal rate of return because internal rate of return is the rate that equates the present value of positive cash flow to the present value of negative cash flow to 0. Okay? Any rate that you assume that produce 0 NPV, that's your internal rate of return. So I can say, since internal rate of return is the rate that equates net present value to 0. Okay? The cost of redeemable debenture of Ronaldoli PLC is 10%. Is 10%. Okay? That's it. In this case, you don't need to calculate internal rate of return again because you have found your answer. So that's that. Then number 2, where there is tax of 40%. Where there is tax of 40%. So let's calculate NPV also. Assume 10%. So create a column for year. Item, let me write it. Cash flow. Discount factor. Then PV. This is 10%. Year 0, 1, 2, 3. Then year 3. All right. Okay. So current market value is 95 naira. Our fixed interest. Then we have the redemption value. So according to the question, we are told there is a tax of 40%. Since you are given tax rates, so we cannot use the coupon rate of 8% again. So we have to go and calculate after tax interest. So working number 2, post-tax interest. The post-tax interest is computed as interest multiplied by 1 minus tax. Anytime you are given tax rates, when you are calculating cost of debt, you must adjust for tax. on your interest. So here will then be equal to 8. Tax rate is 40%. 1 minus 40% will give us 60%. So here will be 4.84 naira 8 kobo. So let's go and put it there. So instead of 8 naira, it will be 4.8. Then we are redeeming at 100 naira at par. Here is 1. Here is 2.487. Here is 0.751. So we multiply. Here will be 95. 2.487. 2.487 multiplied by 4.8 equal 11.94, approximately 12. Then 100 multiplied by 0.75 will give us 75. So 75 plus 12, 87. 87 minus 95. This will give us minus 8. So we assume 10%. We got a negative NPV of 8. Let's assume a lower discount rate that will produce a positive NPV. All right, so let's assume 5. Okay, so here will be 1. Here will be 95. So annuity factor, we have calculated it before. I think we did this somewhere. 2 point what? Yeah, 4 point, no.
4.329.
It's not the same thing. That one is for 5 years. This is for 3 years. So bring out your calculator. 1.05 raised to power 3 minus equal, then minus 1 equal divided by 0.05 equal 2.723. Here is 2.723. Then, of course, discount factor for year 3 at 5%, 1.05 raised to power 3 minus, that's 0.864, 0.864. Okay, so let's multiply. 4.8 multiplied by 2.723 equal 13.07, rounding 13. Then 100 multiplied by 0.864, that's 86. 86 minus, 86 plus 14, that's 99, minus 95, positive 4. So we assume 10%, we got negative NPV of 8. We then reduce to 5%, we got a positive NPV of 4. Now that we have two opposing NPV, we can proceed to calculate cost of redeemable debenture, which is lower discount rate of 5 plus NPV of the lower discount rate 4 over NPV of the lower discount rate 4 plus NPV of the higher discount rate, which is 8. All of this multiplied by higher discount rate of 10 minus lower discount rate of 5. So final answer, cost of redeemable debenture will be equal to 4 divided by 12. Okay. 4 divided by 12, then multiply by 5 plus 5. What do we have there?
6.66.
6.67, right?
Yes.
6.67%. So the cost of redeemable debenture of Ronaldole is approximately 7%. That's how to calculate cost of redeemable debt where there is tax. Remember what I told you last week I mentioned to you that debt is a cheaper source of financing because of tax deductibility benefits. If a company finances its operation with debt capital, the company will pay lower costs to the providers of debt capital because of tax. You will recall the reason why examiner said this question is to test to test the application. Where there is no tax, the company will pay 10% to the provider or to the debt holders, to the debenture holders. But where there is tax, the company will only pay 7%. You can see it is cheaper. It is cheaper when there is tax. So that is how to calculate cost of redeemable debt. Let me know if you have any question for me. If not, we proceed to discussing cost of convertible securities. Let me know if you have any question for me. Any question? Okay. In the absence of no question, let's talk about cost of convertible securities. Costs. You can open to your material, is there, but I want to use this note to explain the concept. Cost of convertible securities. So before we begin to talk about cost of convertible securities, you must understand what is convertible security. What is convertible security? Because of time, let me just put it down for you in a way you will understand better. Now, convertible securities, convertible securities are fixed income securities. Convertible securities are fixed income securities, such as preference share, bonds, debenture, or loan notes. That have the feature of convertibility or that can be converted, to a known number of ordinary shares at a specified future dates. At a specified future date. So that is what is meant by convertible securities. When the contract is being developed, of course, depending on the agreement between the two parties, between the company and the investors. If it is written in the agreement that the investors can convert their debt to number of ordinary shares in the future, then of course the investor will have the right to either exercise the right, okay, they have the opportunity to exercise the right, or they just allow the security to mature and then they just redeem it. All right. However, it should be noted that investor will only convert to ordinary shares only if it is profitable. Let me put it down for you. the investors of convertible security will only convert or will convert to ordinary share only if it is profitable. Otherwise, the investors will not exercise their rights and we just allow the security to mature and then redeem it. And then redeem it. Okay. So if it is not profitable, investor will never exercise the rights. So it will be profitable. It will be profitable. It will be profitable. Let me put it this way. The security will be profitable only if the conversion value at the exercise dates is higher than the redemption value. Okay, so that's that. So what do you mean by cost of convertible security? The cost of convertible security, is the compensation paid to the cost of let me just put this, the cost of convertible securities is calculated as internal rate of return, the same way as done, the same way as computed under the cost of redeemable preference share or debts. Okay, so anytime you're asked to calculate cost of convertible security, just go ahead and calculate internal rate of return. Okay? So it's as simple as that. However, when calculating the cost of convertible securities, the higher of the following should be selected. Okay. So 1, you go and calculate the conversion value. Examiner will give you how the conversion value will be treated. The conversion value will be given to as number of shares you are going to convert at the exercise date, then multiply by the market value. Then 2, the redemption value, anyone that is higher. So if the conversion value is higher than the
redemption value.
redemption value, it means that the security is profitable. All right, it's profitable. Then the investor will exercise their right. But if reverse is the case, that means it's not profitable. There's no motivation to convert. The investor will just allow the security to mature at the redemption date, and they will redeem the security. That's all. Okay, so that's that. Finally, let's talk about market value of convertible security. Examiner can ask you to calculate market value of convertible security. Market value of convertible securities. Now, pay attention. Anytime you are asked to calculate market value, what examiner is simply asking you to do is to calculate present value, whether it is redeemable preference share or redeemable debt or convertible preference share or convertible debt. Is the same thing. When you talk about market value of convertible security represents the present value of future cash flows. Is counted at the yield or rate of return of the convertible security. That's all. Okay. So this represents the present value of expected future cash flows. What are the future cash flows? That is, the future cash flow can be a fixed dividend if it is preference share, fixed dividend, or fixed interest if it is debt. And the principal discounted at the yield or rate of return on the security. So you can call it yield or yield to maturity or internal rate of return. It's the same thing. All right. So that is how to, anytime you're asked to calculate market value of security, just go ahead and calculate present value. The same way you normally calculate NPV. The only thing is just that, when you are calculating NPV, you're starting from year 0. Then you now deduct the present value of positive cash flow minus the present value of negative cash flow. That's NPV for you. But for market value, you are not going to include year zero. So you are going to calculate present value of interest, then present value, if it is a debt, then present value of the redemption value or of the conversion value. You add the two together, it will give you the current market value. So that's all you need to do. Okay? However, when calculating the market value of convertible security, the higher of one, redemption value, or two, conversion value. Conversion value must be selected, okay? Must be selected. All right. So that's that. That's all you need to do. These are just the things you need to know under the convertible security. It's pretty straightforward, nothing strange. It's just the same thing as redemption. Is we are calculating the redeemable debt or redeemable preference share. It's the same. At this point, let's have a short example to demonstrate this. I'll be very happy if we can complete the explanation of work today. If possible, we can even have a question. All right. Okay, then. Yes. Let me stop sharing this and let's go to your material. Okay. Let's solve illustration number 15. Let's start from illustration number 15. This has to do with costs. All right. So I need one of you to read for us, please. Who is helping us? Who is helping us to read?
Let me read.
Okay, go ahead, Tosin.
Okay. Illustration 15. Singapore Limited has 10% convertible debentures with a current market value of 106 naira. An interest payment was made recently. The debenture will be converted to equity shares in 4 years' time at the rate of 4 shares per 10 naira of debenture. The shares are expected to have a market value of 3.5 naira each as at that time. What is the cost of capital to the company for the convertible debentures when company tax is 40%, and assume that tax payment occurs in the same year that the interest payment arises?
Thank you, Tosin. Yes, that is the question. You are asked to calculate cost of capital for the company or to the company for the convertible debenture. All right. In this question, you are given tax rates. That means you must adjust for tax on your interest. Then two, the market value given to us of 106 naira. We are told that debenture interest was paid recently. It means that the 106 naira is already X-int price. Do nothing. No adjustment is needed. The last thing I need to consider here is to confirm from the question, how am I going to redeem? How am I going to determine the conversion value in this question? Okay, on that note, on what basis am I going to convert the debenture to ordinary share capital? Examiner told you that the debenture will be converted to equity shares in 4 years' time at the rate of 4 shares per 10 naira of debenture. So that will be 4 shares multiplied by 10 naira, then multiplied by the market price of 3 naira 50 kobo. Whatever I have will become my redemption value. So I will then I'll compare the redemption value with the conversion value with I'll compare the conversion value with the redemption value. In this question, the examiner did not tell us whether the debenture will be redeemed or how the debenture will be redeemed in the next 4 years. Anytime you are not told how the debenture will be redeemed, you are going to assume it's at par. At par means at 100 naira. So quickly, without wasting more time, let's solve this. Okay. All right. This is solution. So illustration 15. What page is that? Page 32. The name of the company is Singapore Limited. So we are then asked to calculate cost of convertible debenture. So I will say calculating cost of convertible debenture, KD. So like I mentioned, the cost of convertible security is computed as internal rate of return, meaning that we are going to assume two discount rates that will produce two opposing NPV. So in this question, we are given a tax rate of 40%. Therefore, let's design our table for calculating NPV. So create a column for year, description of items, cash flow, discount factor at 10%, then the present value. So this debenture is for 4 years. So we are going to calculate in year 0, which will be current market value of the convertible debenture. Then year 1 to 4, the company must pay annual fixed interest. Fixed interest. Then at the final year, which is the exercise date, the debenture holders can either exercise their rights or they allow the security to lapse and then redeem it. So whatever the case may be, I will not put anything here yet until I do my calculation. Once I do my working, the higher of conversion value or redemption value will come to this year 4. But for now, we leave it blank. That's the way you are going to do it on the day of your exam. So let's go back to the question. The current market value, we are told that the current market value of the debenture is 106 naira and interest was paid recently. So in that case, no need to make any adjustments. I will just put the 106 there. Again, I will go back to the question. How much was the coupon rate given to us? We are given a coupon rate, interest rate of 10%, and we are given tax rate of 40%. So we need to adjust for tax. I will then go and do working. I want to calculate working number 1, after tax interest, that is post-tax. interest. This is computed as interest multiplied by 1 minus tax rates. Interest is 10%. Tax rate is 40%. That means we are supposed to account for 60%. So this is 6 naira. Okay, so I will then come here. Annual interest per unit is 6 naira. Then I need to go and do working again to confirm whether whether the investor will be able to convert to ordinary share capital or they are going to redeem the debenture. So let's go and do our working. Working number 2, we need to calculate conversion value. Then go back to the question. On what basis are you going to convert the debenture to ordinary shares? You are told that 4 shares per 10 naira, okay? 4 shares per 10 naira multiplied by 10 naira, then multiply by the market price, okay? Multiply by the market price of 3 naira 50 kobo. So 4 multiplied by 10 will give us 40. Multiplied by 3.5, that's 140 naira. So conversion value is 140 naira. Then number 3, I need to determine the redemption value. If at the end of year 4, the investors want to redeem the debenture at what price? According to the question, we are not told how the debenture will be redeemed. Therefore, we are going to assume it will be redeemed at par. At par means 100 naira. Okay, so since the conversion value of 140 naira is higher than the redemption value, it means that the debenture holders will exercise their right of convertibility. So at the end of the year 4, they are going to convert the debenture to ordinary share capital because it is profitable. There's motivation to convert. So I will then come here. So on the day of your exam, there's no need for you to put a dash, just leave it blank. Then after you have done your working, whatever you have decided, then you come and write it. So here will be conversion value. So if redemption value is higher than conversion value, you are going to put redemption value. So that's just the difference between redeemable debts and then conversion or cost of conversion, convertible security. It's the same thing. The only difference is just that where you have redemption value, you change it to conversion value if conversion value is higher. That's all. For M period. So the conversion value is 140 naira. So here will be 1. Annuity factor of year 1 to 4 at 10%. Will give us 3.170. Discount factor for year 4 at 10% will give us 0.683. Then you multiply. There is 106. 6 multiplied by 3.17. 3.17 equal, that's 19, approximately 19. Okay. Then 140 naira multiplied by 0.683. 6, 8, I was trying to
96.
Thank you. 96, 95.62, that's 96. So 96 plus 19, that's 115. 115 minus 106. All right? That should be positive 9. That's positive 9. So we assume 10%. We got a positive NPV of 9. Let's assume a higher discount rate that will give us a negative NPV. So we're assuming 15%. Somebody should give me annuity factor at 15%. While I do the discount factor for year 4 at 15. 1.15 raised to power 4 minus equal, that's 0.562. 0.562. What's the annuity factor? Okay, minus 1 equal
2.854.
2.855.
854. Okay. Yes,
Okay.
855.
2.855. So let's multiply to get the
Times 6.
present value.
17 points. You can do 17 there.
17.
Yes.
Then 140 multiplied by 0.562.
79.
79. 79 plus 17. That's 96.
It's
96 minus 1 minus 106.
That's 10.
10. Okay.
Mm.
Let me confirm something.
I think we should
140.
reduce.
140 multiplied by 0.562.
Mhm.
That's 79, correct. Then 6 multiplied by 2.855. 17, correct. So plus 19, sorry, plus 79. Hold on. I do something else. 79 plus 17 equal, then minus 106, that's 10. Okay, that's minus 10. So here is 10. So then calculate the cost of convertible, KD, equal to lower discount rate of 10 plus NPV of the lower discount rate, which is 9, over NPV of the lower 9 plus NPV of the higher 10. So multiply by higher discount rate of 15 minus lower discount rate of 10. What do we have here? KD is equal to what? Final answer. 9 divided by 19 multiplied by 5 plus 10. What do you have? 9 over 19 equal, multiplied by 5 equal, that's 2.4. That's 12.4. 12.4 percent. Okay, 12.4%, or you say approximately 12%. Okay, so that's that. This is how to calculate cost of convertible security. So you can see it's no different from cost of redeemable preferential and redeemable debt. The only thing is just that at the redemption date, you are going to compare the redemption value with the conversion value. Anyone that is higher will go into that box. That's all you need to do. All right. So let's have one more illustration on this. Then we then talk about weighted average cost of capital. So let's solve illustration number 14. Yes, who is helping us to read this? Illustration 14. Lacassetti PLC.
Lacassetti PLC
Thank you.
as an issue. Lacassetti PLC has an issue, a convertible debenture with a coupon rate of 12%. Each 100 naira unit may be converted to 20 ordinary shares at any time until the expiry date, and any remaining debenture will be redeemed at 100 naira. The debenture has 5 years to run. Investors will normally require a rate of return of 8% per annum on the 5 years debt securities. Should the investor convert if the current share price is 4 naira, 5 naira, or 6 naira?
Thank you, Tosin. So you have to be very careful. All right. You must be very careful. You must understand the requirement of a question before you jump at it. So in this question, the examiner wants you to advise whether investors should convert at 4 naira, 5 naira, or 6 naira share price. For you to be able to answer this question, you must know, as of today, how much, you need to determine the current market value of the debenture, of the convertible debenture. If the company wants to redeem this debenture in the next 4 years, what will be the market price? What will be the market value? So you keep it on one side. Then you now calculate the conversion value at 4 naira, 5 naira, and at 6 naira. So at any price that the conversion value is higher than the current market price of the debenture, that is the price at which the investor should convert. That's all you need to do. This has nothing to do with cost of convertible. Examiner is simply asking you to advise which price should they convert. So to solve this, let me just stop sharing and then move to the working notes quickly within the next few minutes. Okay. Solution to illustration 14. Still on the same page. I think that's page 48 or 49. Let me confirm. Sorry, page 32. All right. So the name of the company is Lacassetti PLC. So examiner is asking you to advise whether investors should convert at the current share price of 4 naira, 5 naira, and then 6 naira. So to answer this question, 2 steps you are going to take, or 3 steps. The first step is to calculate the current market value if the debenture is to be redeemed. We keep it on one side. Then step 2, we calculate the conversion value at each share price. Then step 3, you advise whether you advise on the price or the price they should convert. So let's start with the first step, which is to calculate the current market value of the debenture. So I would then say calculating the current market value of debenture. Remember what I told you earlier. The market value of debt represents the present value of future cash flows discounted at the yield or rate of return on the security. You want to calculate the market value of debenture. What are you supposed to do? Your cash flow will be in 2. Your first cash flow is the fixed interest, and then the second cash flow will be the principal redemption value. So discounted at the yield, like I told you earlier, yield is the same thing as rate of return, or you call it yield to maturity. The internal rate of return that you have calculated before, that is your yield. That's the yield on the security. So yeah, and I also said that anytime you want to calculate the market value of redeemable debt or redeemable preference share, just calculate present value the same way you normally calculate your NPV using that same table. The only thing is that you are not going to include year zero, because once you include year zero, that means you are simply calculating NPV. In fact, you can't even include year zero because the market value will not be given to you. You are the one that will determine, and that's what you want to calculate. Therefore, I will create a column for year, description of items. We have cash flow here. We have the discount factor. I will go to the question, what's the yield? What's the rate of return given to us? We are given a yield of rate of return of 8% per annum on the 5 years debt security. So 8% is the yield. So here will be 8%. Then we are going to have present value that we want to calculate. So again, I will go back to the question. We are told that the debenture has 5 years to run. Therefore, the company will pay annual fixed interest for the next 5 years. Year 1 to 5. Fixed interest. Okay. Then in the final year, at year 5, this debenture will be redeemed. So here will be redemption value. So I'll go back to the question, how much interest are we looking at? We are told that coupon rate of 12%. Coupon rate is the same thing as interest rate, which is 12%. Before I put down the 12, I need to confirm from the question if I'm given tax rates. So if you are given tax rates, you must adjust for tax. But where you are not given tax rates, just ignore and use it like that. So here is 12. We don't have tax rates. So how are we going to redeem this debenture? At par, at premium, or at a discount? So we are told at 100 naira. So that's at par. Therefore, I need to calculate annuity factor of year 1 to 5 at 8%. So 1.08 raised to power 5 minus equal, then minus 1 equal, divided by, sorry, that's error somewhere. I did not put the right number. Okay, 1.08 raised to power 5 minus equal, then minus 1. What am I doing? It's my eyes. Do me
3.993.
3.993, Abi.
3.9, yeah.
Because I'm not getting, here is 3.993. Then, of course, discount factor for year 5 at 8%. You give us 0.6 watts or 1.08 raised to power minus 5. What do you get?
0.681.
0.681. Okay. 0.681. So let's multiply. Here will be 68. Then 12 multiplied by 3.993. What do you have?
48.
48 plus 68.
116.
116. So the current market value of this debenture is 116 naira. So if the debenture holder wants to redeem, if the debenture holders wants to redeem the debenture, it will be at a price of 116 naira. That's the current market price. Okay. So we need to compare this with the redemption with the conversion value. For the conversion value at 4 naira, 5 naira, or at 6 naira.
6 naira.
Okay, so number 2, conversion value. So to get the conversion value, on what basis? We are told 20 ordinary shares. 20 ordinary shares at the share price of 4 naira, 5 naira, and then 6 naira. So I will then multiply to get the conversion value. So 20 multiplied by 4 will give us 80 naira,
80.
100 naira, then 120 naira. Examiner is now asking you, should investor convert at 4 naira, 5 naira, or at 6 naira? So based on your calculation, you'll be able to decide. You can see that at share price of 4 naira, conversion value of 80 naira is below the current market price of 116. Therefore, investor should not convert at 4 naira. At 5 naira share price, conversion value is 100 naira. This 100 naira is below the current market value of 116. Again, investor should not convert. At the share price of 6 naira, the conversion value is 120 naira. 120 naira is higher than 116 naira. Hence, investor should convert. So let's advise. Investor, let me go back to the question. Is it investors or investor? Let me confirm. Investor, okay? So I would then say investor from the calculation shown above. From the calculation shown above, the investor should not convert to ordinary share capital at the share price of 4 naira and 5 naira, since the conversion value of 80 naira and 100 naira are below the current market value of 116 naira. However, investor should only convert at 6 naira share price, since conversion value Let me write it. Since conversion value is higher than the current market value of 416. That is, what we are saying is that it is profitable. It is profitable to convert at 6 naira share price. Okay, so that's it. That's the end of the question. That's the end of the question. All these little things, they matter. Okay. All right. Let me know if you have any question for me. We have roughly 40 something minutes to go. Let's spend the remaining minutes to explain weighted average cost of capital. Let me know if you have any question. If not, there's no need for me to be switching again. Let me just use the material to explain weighted average cost of capital. Weighted average cost of capital. WACC. You will recall when we started this topic, I told you that to calculate traditional weighted average cost of capital, there are 4 procedures you are expected to carry out depending on the information available in the capital structure. The first step is to calculate cost of equity. Step 2, you compute cost of preference share. Step 3, you determine cost of debt. And step 4, you estimate weighted average cost of capital. So far, so good. We have completed explanation on the first 3 steps. The last step is what we want to do. All right. Therefore, what do you mean by WACC? What is WACC? What is weighted average cost of capital? Remember what I've been telling you all this while, that all these short examples that we have been solving, that's not the kind of question you are going to see on the day of your exam. But there's no way you are going to jump to calculating WACC if you don't understand all those things that we have discussed so far. How to estimate cost of equity, cost of preference share, and then cost of debt. If you don't know them, there's no way you'll be able to do justice to weighted average cost of capital. Therefore, what do you understand by WACC? So we can simply put WACC represents the overall cost of capital or rate of return, cost of capital to a firm. Okay? WACC represents the overall cost of capital to a firm. It is the average. It is the average cost of a company's finance. It is the average cost of a company's finance weighted according to the proportion or percentage of each source of capital, of each source of finance or source of capital or source of funds in a company's capital structure, or in a company total pool of capital. So that is WACC. That's the meaning of WACC. When you look at my explanation here, I said it is the average cost of a company's finance weighted according to the proportion. Okay, let me write this according to the proportion of each source of funds, source of finance in a company's total pool of capital. Let's say, for example, in a company's capital structure, you have ordinary share capital. Let's say you have ordinary share capital of 1,000 naira for simplicity. You have preference share capital of, say, 200. Then you also have debt capital, say, 300. When you add all of this together, you have 1,500. That's the total pool of capital. All right? That's the total pool of capital in the company's capital structure. Each source of finance has its own underlying cost. Based on our explanation so far, the cost associated with ordinary share capital is the cost of equity, denoted as KE. Cost associated with preference share capital is cost of preference share, and then cost of debt for debt capital. What we are now saying is that as far as WACC is concerned, you are supposed to find the average cost of capital. To do this, you are going to multiply the weight of each source of finance with the cost of individual capital. Then you find the total. What do I mean by this? For example, based on this, our hypothetical figures, I can then say for equity is denoted as E. All right, I can say equity, proportion of equity will be 100, will be 1,000 over 1,500 multiplied by cost of equity. Whatever I have, I will put it there. I will do the same thing for preference share. The value of preference share in the capital structure is 200 over the total of 1,500 multiplied by cost of preference share. Whatever I have, I'll put it there. Then the last one is the value of the debt. Debt is 300 over 1,500 total multiplied by cost of debt. Whatever I have, I will put it there. I will then add everything together. This will then represent my WACC. Okay? That's why we are saying that WACC is the average cost of a company's finance weighted according to the proportion, okay, of each source of finance in a company's total pool of capital or in a company's capital structure. Okay? So that's basically what WACC is all about. Now, how do you then estimate WACC? WACC can be calculated, okay? WACC, let me write that. WACC can be calculated using either market value or book value. Okay, WACC can be calculated using either market value or book value. How do you calculate WACC using the market value? First thing first, you need to know what is even market value. Okay, market value, MV. This is the price determined. Let me put it down because of time. I'll be happy if I can solve at least one illustration on this. This is the price determined by the market forces. Market forces of demand and supply Okay? It is the most acceptable and realistic. It is the most acceptable and realistic value to the investors. In the past, ICAN asked as a sub-requirement, why is market value preferable to book value? Okay, so this is what you are going to be saying. All right. Investors prefer the market value because it's determined by the market participants. Unlike the book value that is stagnant, it's just there in the balance sheet. It's historical. Book value is historical. So it doesn't incorporate the current information. It doesn't incorporate the market condition. Therefore, investors they don't rely anything on the book value. Usually, market value is used. All right. So that is for that. Then, how do you estimate market value? So let me show you. Estimating market value. Okay. So market value of equity, denoted as E, can be calculated as number of ordinary shares multiplied by X dividend share price, X dividend share price. Okay, or you can say equity value equal to, in case you are not given number of shares, then you have to use share capital. So share capital divided by nominal price divided by nominal price. The nominal price is the same thing as a par value or face value of the ordinary share multiplied by XDIV share price. So that's that. Then market value of preference share, denoted as P, is calculated the same way as market value of equity. The only thing is that you are going to use number of preference share multiplied by XDIV preference share. XDIV, X dividend of the preference share. Or you can say value of preference share equal to share capital when you are not given number of shares over the nominal value. Nominal value or nominal price multiplied by XDIV share price. And the last one is the market value of debt, denoted as D, debt value. Debt value is calculated as nominal value of the debt multiplied by X interest price, all divided by 100 naira. Remember, debt is always quoted at 100 naira per unit. So this is how to calculate market value of equity, market value of preference share, and then market value of the debt. So this is the formula to calculate. Anytime you want to calculate WACC, this is what you are going to use to find find the weight. Okay, to find the weight. of each source of finance. So that's basically how to estimate market value. The next one is book value. All right. Now, before we go to book value, note market value should always be used to estimate WACC, except examiner says otherwise. At times, examiner can ask you to use book value. Whatever the case may be, it should always be market value. So what that means is that you are going to do your working first. All this formula that I gave to you is what you are going to use to calculate your market value. Then thereafter, you are going to use the market value to form the proportion of equity, proportion of debt, proportion of preference share. You then multiply with the cost of individual source of finance. Okay, so let's talk about book value. Okay, this represents the value shown, value of figure as shown in the statements in the balance sheet. What's wrong with this? In the balance sheets or statement of financial position. Okay. In the calculation of WACC, or when calculating WACC, using book value, ordinary share capital and reserves must be added together to form the proportion of equity in the company total pool of capital. Okay, so anytime you want to calculate WACC using book value, you must add ordinary share capital and reserves. This will form the proportion of equity. I did not include that. To form the proportion of equity in the company total pool of capital. So this is what we're saying. For example, let's say, for example, in the company's capital structure, you have ordinary share capital of 300 naira, 1,000 naira. You have preference share capital of 200. Then we have debt capital of 300. You're also given reserves, say 500. When you add up, total is 2 million. Sorry, total is 2,000. What we are saying is that all these figures you have in the balance sheets, they are the book value. These are the book value. If you now want to determine the proportion of equity denoted as E will then be equal to ordinary share capital plus reserve. This plus this must be added together. Therefore, 1,000 plus 500 divided by the total of 2,000. So whatever you have, you can multiply with 100%, you get it. Then the proportion of preference share will be equal to 200 divided by 2,000 multiplied by 100%. This will give you 10%. That's the proportion of preference share. The proportion of the debts will be equal to 300 over 2,000 multiplied by 100 over 1. So this should give us like 16%. So that means this one must be 74% or whatever. 74 or 75. I don't know. I'm not using calculator. All right. So that will give us the proportion of equity, preferential, and debt. So what we are saying is that the bottom line is that when you are calculating weighted average cost of capital using the book value, ordinary share capital and reserves must be added together to form the proportion of equity and debt. So that's basically that. The last thing we are going to discuss here is the formula for calculating WACC. Okay? Formula for calculating WACC. Oh, sorry, this is 15%. Okay. All right. How do you then estimate WACC? Estimating WACC. Estimating weighted average cost of capital. WACC can be calculated using the formula below. Okay, using the formula below. We're assuming that we have the three major sources of long-term financing in the capital structure. We have ordinary share capital, preference share capital, and also debts. So in this case, WACC will be computed as value of equity or equity value over equity plus preference plus debt value. All of this multiplied by cost of equity plus value of preference share over equity value plus preference share value plus debt value multiplied by cost of preference share plus debt value over total value, that is equity plus preference plus debt multiplied by after tax cost of debt. Okay? So this is the formula for calculating WAG. This is the formula for calculating WAG, where, like I said, KW equal to weighted average cost of capital, KE, cost of equity, KP, cost of preference share, then KD, cost of debt, then KD 1 minus tax equal to post-tax or after-tax cost of debt, post-tax cost of debt, then E equal to equity value, P, let me write it, P equal to value of preference share, then D equal to debt value or value of debt. So that's that. If I don't want to use formula, I can also use table to get the same answer. All right. Alternatively, I can use tabular method to get the same thing. Alternatively, the table below, we're almost done. The table below can be used to estimate WACC. Okay. So let's say we have the three of them in the capital structure. This should be the type of the security in the capital structure. We have equity, preference share, then we have debts in form of bonds, debenture, or loan notes. Then we have the value. We have the value of each security. So this value can be, it could be market value or book value, depending on the information available or what examiner wants you to use. Let me write it. Then the cost of individual capital that you have computed, cost of equity, cost of preference share, and then cost of debt. So cost of equity, cost of preference share, cost of debt. So here you are going to have ash total. So the value of individual source of finance, put it there, sum it up. The value multiplied by cost of individual capital, you put it under the ash total. You had everything up. So WACC, denoted as KW, will then be equal to ash total over total value multiplied by 100 over 1. So whether you use the formula or you use this table, you must get the same answer. However, you have to get used to the formula, particularly when you get to project specific, is the formula that you are going to be using in most cases. Now, on the day of your exam, it is possible you may not have preference share. If you don't have preference share in the question, then the middle formula will not be there. You remove the middle line. So the preference share. So it will just be equity and then debt. Okay? So it's not at all. If you don't have preferential in the question, you are not going to use the entire formula as it is. So you are not going to use the entire formula. So if preferential is not there, you are just going to do equity over equity plus debt multiplied by cost of equity plus debt over equity plus debt multiplied by after-tax cost of debt. That's all you need to do. But if you have the three of them in the capital structure, you have to write out use the entire formula. So that is basically that. And then, yes, this is all about weighted average cost of, let me check to see if there's anything I miss. Let me stop sharing this and go back to, let me use the golden book and see. Okay. Work. Let me see. But, 1 minute. I want to check out if I don't miss, if in case I miss anything under the work. Okay. Yeah, apart from the assumption, okay, there are underlying assumptions associated with weighted average cost of capital. One of the assumption is that the debt equity proportion will not change. Okay, it is assumed that the percentage of equity and debt in the capital structure will remain the same. All right, because once it changes, then the assumption will not work. Okay, it will not work in the calculation of the work. All right, then point number 2, the second assumption is that the operating risk arising from variability in cash flow of the company will remain constant. All right. So we are saying that the cash flow will remain constant. It will not change. It will not vary. Then 3, projects will be financed from the total pool of capital. Okay, we are saying that project will be financed from the company's total pool of capital, that is from the information on the capital structure. Then lastly, project size generally is insignificant. Project size is insignificant relative to the company's size. So what that means is that any change will still remain, will not be material, It won't have much impact on our calculation. So if any of the criteria are not met, it will not be appropriate to appraise the project using the traditional weighted average cost of capital. So all these assumptions, all these criteria, all these determinants, if they are not present, it will be almost impossible to appraise a project using the traditional weighted average cost of capital. All right. So this is where we are going to call it a day. In our next class, by the grace of God, going forward for the next 2 periods now, we are going to be solving questions. I'm not sure we can complete work in our next class because at least we should be able to solve 3 to 4 illustrations, different scenarios, then before we can then move to project-specific cost of capital. In any case, this is going to be the end of today's class. Let me know if you have any question for me before I say bye-bye. Any question for me? I can see some of you have disappeared, but Ahmed Adebayo is still on. Akko is online. Okay. Charles, Clement, David, Elizabeth. I can see Jeffrey Enauro, Ita, okay, Faith, Hussein, Moses, Oluwatosin, Sharafaddin, and then I can also see Temitope,
Hello, sir.
Usman. So thank you for holding on. Yes, somebody is talking to me.
Sorry, is it possible for you to drop this video tomorrow morning for us?
The issue is that, see, it's very easy for the responsible person to drop the video almost immediately. But the issue is that before the class begins, some student will go to the Zoom, and once you join the class, this will be recording. You can have like hours of empty recording, and we can't be sharing that with with students. And that's why the responsible person will need to edit, cut out all those things. And then when you are doing the editing, it takes time. It can drag for hours, depending on your internet, the kind of internet that you are using. So it can drag for hours, and that's why it usually take a day or more for the responsible person to be able to share it. Yeah, that's why. But again, anytime you attend a class and the video has not been shared within hours, you can comment on each group that, please, when is this video going to be ready? All right. Okay.
All right. Thank you, sir.
You're welcome. Any questions so that we can close the class? All right. So in the absence of no further question, I want to say thank you to every one of you for waiting behind to the last moment. I will see you
Thank you.
again next week, Tuesday, by the grace of God. Good night, everyone.
Thank you very much, sir. We appreciate.
You are welcome.
Thank you.
You are welcome. Okay. Yeah.